Unit 1, The Financial System. Lecture 3, Financial Instruments and Markets, Part A. Financial instruments. By definition, a financial instrument is a document or contract that can be traded in a market, but most importantly, it represents an asset to one party and a liability or equity to the other. Financial instruments were created to satisfy the needs of the various participants of the financial system. These include lenders and borrowers, and financial intermediaries, to name but a few. Financial claims can be categorized in two ways, either as primary securities. These are issued by the ultimate borrower, and two common examples, I would say, are equities and bonds. And then we have indirect securities. These are issued by financial intermediaries. There are a number of different financial instruments. The following list represents some of the more common types. There are equities and shares. These represent ownership in companies. There are debt instruments or bonds. In this case, we're looking at long-term debt. They tend to be issued more by governments and corporates. There are deposit instruments. They are commercial paper. This is a type of short-term debt issued again by corporates, and it's a money market instrument with a term of less than a year. They're instruments of investment vehicles. And then finally, we have derivative instruments. Derivative instruments are assets that are based on other asset classes. So the four main types are futures, forwards, options, and swaps. And you can buy an option on a share or an option on a bond. Within the two categories of indirect or primary securities, financial instruments can be further categorized as marketable or non-marketable. Now, in the case of investments, a marketable instrument is an instrument that can be traded in the secondary market. Now, the secondary market, which we'll talk about in detail later, is a market in which investors trade with each other. So they don't trade with the original issuer, they trade with each other. And for example, an investor who bought a share in a company and no longer wants to hold on to that share can recoup his investment by selling that share to another investor in the secondary market. Usually, the instruments that trade in the secondary market are issued by corporates and government sectors, and they're referred to as the wholesale sector. The non-marketable instruments, these cannot be traded in the secondary markets, so they actually have to be traded with the original issuer. So if an investor wishes to recoup their investment, they have to go back to the original issuer in order to get their money. And this type of instrument generally involves the household sector or the retail sector. Here we're looking at the different types of primary and indirect securities that are issued. Financial markets are an essential part of the financial system because this is where the financial instruments are traded. By definition, financial markets are institutional arrangements, mechanisms, and conventions that exist for the issuing and trading of financial instruments. In South Africa, we have the Johannesburg Stock Exchange. Elsewhere in the world, you have the London Stock Exchange, the New York Stock Exchange that we are more familiar with. So a financial market is not a single physical place, but it involves millions of participants who are spread across the world and linked by vast telecommunications networks. Buyers and sellers from all over the world who are transacting or investing in financial instruments come together to set prices for those instruments as part of this process. Now, interestingly enough, you have financial markets, stock exchanges all over the world. And actually, companies can be listed on more than one stock exchange. You know that Anglo American is listed on the London Stock Exchange, the New York Stock Exchange, and the South African Stock Exchange, and shares are being traded continuously all over the world. Now, the financial markets that people are most familiar with is the equity or the share market. The Johannesburg Stock Exchange is the South African equity market. But there are a number of different types of financial markets. There is the foreign exchange market. This is the market where currencies are traded. So the market where you would buy and sell dollars and pounds and other foreign currencies. There is the capital market. This is the market, the equity market that we're familiar with, but there's also the bond and long-term debt market that are part of the capital market. There is the money market, and here we deal with short-term securities, securities whose maturity term is less than 1 year. And then there's the commodities market. Examples of commodities that we are familiar with: oil, used for petrol, and gold. And what is very interesting is that part of all of these markets is what is referred to as the derivatives market. We'll talk a little bit about it later, but every single asset class, every single financial market, the instruments that trade on it, can form the underlying assets in a derivatives contract.